we've got some new research reports, and because we can talk about bubbles all day long, but I think actually looking at some empirical evidence, the research, that gives us a lot more information, and we can actually have some sort of an educated opinion. So let's get into it. You'd like to start with the CoStar report, or where do you want to go first, Matt?
Yeah, CoStar sounds great. There is a
Okay.
lot of breadth in this 95-page report. It covers much more than multifamily, industrial, retail, office. It's a global report because they're in Canada and Europe. So there's a lot to it. But before zeroing in on the U.S. multifamily section of the report, they do have a good that provides some nice context in their projections for the overall economy in the United States. CoStar is seeing some things that viewers and readers of the Gray Report will be very familiar with. There's increasing wages and employment. They're expecting measured rate hikes from the Fed. This is all expectations for 2022. Continued inflation pressures that may soften later in the year. And GDP growth at its second highest since 2010. Now, a couple of things to note here, which I think is really interesting when it comes to GDP growth, and again, also a growing economy, an economy that is doing great is great for everyone. It's great for multifamily. This 2022 growth is going to be GDP growth surged in 2010 as we were climbing out of the Great Recession. 2021 GDP growth saw us climbing out of the 2020 economic crisis from the pandemic. But 2022's projected growth here isn't climbing out of a slump as much as it's continuing the momentum of 2021 growth. And if you look at the graph of US GDP over the years, we haven't seen 2 years of major GDP growth like this since the early 1980s. And so they really project that we're going to see it seems a lot like boom times. And so there's a lot to be hopeful for when it comes to 2022.
I think that's a good point, Matt. Just looking at GDP growth, you made a lot of really good points. I mean, overall, CoStar is predicting really good economy for 2022, even with the Fed hiking interest rates, which they anticipate that they certainly will. How much and how far, is yet to be seen. But we're going to have higher GDP growth, which is good economic growth. Outside of 21, it's going to be the best in the last decade or so. So this it should be good news, and that should continue to buoy most markets. Unless there's some black swan out there. And Matt, just because you covered it really well, you kind of summed up everything. This report, they're like predictions white papers, the 2022 Global Predictions white paper. So I just want to go through kind of just quickly each prediction. We're going to have to go through each paragraph. But so employment will recover to pre-recession levels despite labor shortages. A lot of talk about the fact that people just haven't returned to the workforce yet. And where are all these workers? The quit rates are up. We've talked about previously, Matt, that a lot of people are starting businesses, and just because they're not getting a new W-2 job doesn't mean it's going to lead to lower economic activity. In fact, that's actually really great for the economy. Jamie Dimon just saying yesterday this is the first time he was speaking to CNBC. This is really the first time in his life he has seen such wage pressure. So we're going to continue to see wages increase, and that's really a good story for everyone. You can see in these graphs. And again, the best way to get these reports, either grayreport.com or signing up for the Gray Report newsletter over at graycapitalllc.com. We're on track. Job openings, we're way back. We're above pre-pandemic levels. Employment, we're essentially, they're forecasting so that this black line right here is the point of I guess it's really not. Usually this black line indicates that's where their forecast is. They're forecasting essentially near the end of 2022, we're going to be back to the same employment levels that we were prior, but at higher wages. So that was the first prediction on jobs. Number 2, Fed will lift rates by the end of 22. Most people are anticipating that maybe start in March. How much and at what rates we will see. That'll be interesting because we've seen the 10-year Treasury, and this probably should have been a headline too, Matt. Is 10-year Treasury is over 1.75. It was 1.78, I think, yesterday. So that very incredibly important borrowing rate is going up. The shorter end of the borrowing curve, though, or the yield curve, is still low. So for 30-day SOFR, 30-day LIBOR, that a lot of other variable rate mortgages are based off, they're still staying incredibly low, essentially zero. So when the Fed raises the Fed funds rate, it will be interesting to see how those other shorter maturity notes also rise. Here is a projection of current Fed funds rate, and then the median market implied rate forecast, and then a range 90%. So really kind of looking at the low end of the range and the high end of the range. And this is for the Fed funds rate, not the 10-year Treasury, the Fed funds rate. I remind everyone that the 10-year Treasury was well below 1% and I think dipped down to 0.4% at one point for a 10-year Treasury. We're now they're anticipating with the Fed funds rate essentially at zero. The highest forecast is for the Fed funds rate to be just over 1% by the end of the year. And that'd be over where the 10-year Treasury was a little over a year ago. That median forecast, though, it's basically right at 0.75. And that really puts a floor on the rest of the yield curve. So that really should move rates up considerably. But the lower end of the projections, which in my opinion, and this is probably not correct, but you take it for what it's worth, I think that we'll either be shooting in between the median and the lower end of the 90% range. I think that they will be cautious.
And if you look, I mean, this is coming off a high peak in terms of the rate. So it's not like, if you look at that graph, it's not like we're going to return to those highs in the next year or really anytime soon or ever. So I don't think that it is an emergency situation. It's just like the good times are not necessarily as good as they used to be when it comes to getting cheaper debt.
That's true. Yeah, we're probably not going to see a whole lot of sub 3%. It's really, if you look at a lot of the charts, and I think a little bit further on in the CoStar report, they're talking about the cap rate and interest rate spread, which, as we know, that doesn't mean everything, but it's an important measure to track to kind of give an idea of yield. Again, it's not everything, but it certainly is. It's something to pay attention to because it does, in general, correlate to return. At least when you're initially buying the property. Obviously, you're going to be doing some kind of value add, increasing cash flow, but just that spread it's an indication really from demand in a macro sense. Okay, so we have the blended cap rate, 10-year Treasury rates, and spread. So blended cap rate, this is all capital markets. This is all commercial real estate, not just multifamily. But so the spread increased to its peak here, kind of mid 2020. This is when all of a sudden there was a lot of fear in the market. People didn't know what to do, and we were looking
the wait and see era.
Yeah, because cap rates hadn't started declining just yet. You could still maybe get some for a 5 cap, 5.25 cap. We made some good acquisitions right around this time period. A lot of people are sitting on their hands. But as cap rates have compressed and now the interest rates, borrowing rates are slowly moving up. They haven't moved significantly, but you're no longer underwriting to, 2.75, 3%. We're underwriting. Well, we never really were. You're underwriting closer to, again, we always were 3.5, 3.25, all the way up to 4, 4.5. And you may even see people underwriting up to a 5% interest rate here in the near future, depending on where rates go. But the conclusion that I made is, and this is like a little bit of a forecast. We're talking about to the end of 2022. We're basically returning to 2018 levels.
Yeah.
And we were finding good deals. Now, albeit finding good cash flowing deals was a little bit, I remember looking for deals and they were definitely skinnier. You're no longer able to get, double-digit cash flow on your underwriting in the first year, 2 years, even with interest only. You really needed to use interest only to be able to get the cash flow that you needed. people are still using interest only today, but returns should compress, and especially compared to throttled growth going forward. If we really see growth to slow down, as is projecting, and it's probably healthy.